And thank you for remaining with us. I'm still talking to Mr. Malik Musumba, who is an investment strategist, a man with wealthy experience in financial markets, as well as other products concerning the finance sector. Mr. Malik, we were still talking about some of those special products on the market, and we would like to further understand an ETF. In very simple language, what is it? What does it mean, and how does it, help and benefit the shareholder?
Okay, well, a derivative, as the name suggests, it's derived from an underlying asset. For example, if you have a stock and you have let's say, Uganda Clays or an Apple stock, for that matter, if you have a derivative, you have something that kind of is derived from that stock. It tracks it, but yet again, it allows you to have leverage. So the way it works with a derivative is, if let's say you had 1,000 shillings or $1,000, right? And you wanted to buy a stock. An Apple stock is pretty much quite pricey.
30,000.
So what the derivative does, it allows you to buy more of that with just 10%. It's more housing industry that you only need 10% as a deposit, and then you can own the building but have to keep paying. Keep paying. So that's what a derivative does. It allows you to take ownership of a basket of stocks that you wouldn't have otherwise been able to afford at a fraction of the price. However, the problem with that is any swings in the market can cause either utter collapse or oversized gains. For example, if we're to do the quick math and say a stock moved by 10%, right? If the stock was 1,000, but you had 1,000 shares, right? That's like 1 million. If you move 10%, then you have 100,000. But remember, you only started out with what? 1,000.
Yes.
If it were to move the other way around, then you'd be down by 100,000. And remember, you started out with 1,000, so that's a loss of 99,000 that you'd have to cover. So that's derivatives.
So in other words, when the market moves in your favor,
you'll make outsized gains.
Yes, but when it doesn't, it moves the other way.
Exactly.
Same thing.
That's why I said it's a double-edged sword. It can work for you or against you. So I'd really advise novices to stay away from derivatives. Yes, because with derivatives it comes huge loss or huge gains. It's more or less a gamble.
Yeah, and in our stock markets here in East Africa, I doubt, maybe Kenya, I'm not sure, but I doubt we have such a product.
Those products are usually what we call sophisticated products for sophisticated investors.
Yes.
It's not a product that is usually out there. These are products that are developed over time, given the risk appetite of investors and how sophisticated they are. And that's why you may not find them in developing markets. For example, the East African markets.
Now let's talk about the ETFs as well. What do you make of them?
Well, I believe those are quite a good alternative. I believe that individual investors should actually look into them because these are low cost, they're easy to buy into, they're good for diversification, and they also provide what you'd call market returns. So that means their returns are not too far off the market because of the way they're structured. That means if the stock market on a whole was to go up by 10%, you can expect your returns to be around that region. Maybe a little more, maybe a little less, depending on the weighting. But at the end of the day, you'll be around that area. As opposed to taking out individual stocks, which could either work for or against you, because at the end of the day, with all things, market cycles, there's different industries that boom. For example, during COVID, we saw airlines go down. Anything to do with transportation, aviation went down. Oil was trading in the negatives. And then currently in Uganda, as you can see, oil is booming. and everything else is pretty much down. So that's the thing about investing in individual stocks. Unless you catch into the right market cycle and know which industry to invest in based off the trajectory, then you can either make good returns or you could actually be in a loss.
Yes.
Yeah.
In Uganda recently, something came up called the Unit Trust Fund, or
Yeah.
the collective investment schemes. And according to reports from the Capital Markets Authority, these schemes last in the past 3 months after, I think, between December and March, they made a total of about 1.15 trillion worth of savings of Ugandans.
Okay.
And they have very good returns. For example, some of them have 10, 15, 11% per year. And these fund managers, what they do, they get funds and give them out to different investments and then return at the end of the day. And they're very liquid. Within 2 days, you can get back your money.
Yeah.
I don't know, what do you think about such a kind of investment scheme? Is it something that's going to provide a better option for Ugandans to invest?
I think it's a good diversification option because at the end of the day, you do not want to put all your eggs in one basket.
Yeah.
If you can allocate a bit of your portfolio into, like, let's say, unit trust and have professional fund managers actually manage for you your money, it's a good way to have something on the side that keeps bringing you what you would call predictable or more or less returns, something that you could be happy to, to receive at the end of the day. However, if you're just trying to build your wealth, if you're trying to grow a portfolio, I would personally not encourage anyone to invest in unit trust because at the end of the day, in as much as 10-15% seems quite a sizable number, you have to also take into factor things like inflation, cost of living and whatnot. So you may find that at the end of the day, that 15%, because I was actually reading a report and they said inflation increased from December last year, right? And this was a report that was written by, I think, UBOS to around February, and this was just around February because I was working on some report for something I was doing, and they say food inflation had increased by 6%. And that was just within those 3 months, from like December, January, Feb, those 3 months. So one have made actually a profit of your investment if at all inflation keeps at the rate at which it is, So that's always something to think about, not just looking at arbitrary numbers, but the real cost of items. Yeah.
The inflation bit now, we are talking about sustainability of the financial markets amid these tough times.
Yeah.
The entire world is grappling with inflation, honestly. Many banks around the world are increasing their rates, central banks in particular. The Federal Reserve increased its rate, and definitely that cut across almost all banks. Even here in Uganda, recently from 7% to now 7.5%. Kenya is also at 7.5%. What do you think is the best strategy to use to bypass this and be able to still safely invest in financial markets without feeling so much the heat of the inflation bit?
Yeah, somebody said the best hedge against inflation is cash. And in as much as that may sound a bit bizarre, because cash keeps losing value every other time during inflation, but what that does is it allows you to have ammunition to actually invest in the markets. For example, because of inflation, the governments will raise rates, the Fed. The central bank has to raise its rate in order to curb the excess money supply. And in doing so, one of the things that affect the stock markets is increase in what? In rates. So when rates increase, investors get panicky and they want to sell their stocks, their assets, because these are tough times and whatnot, and they figure it's better for them to go cash. So if you were to look at the stock market right now, world over, from the US, the stock market has tanked. It has tanked way from the times of quantitative easing, it has really, really gone down. You know, right now everything is from all-time highs, even crypto itself. So if you're in cash, as opposed to being fully invested in the stock market, this is the time for you to pick up gains.
Yes.
Like Warren Buffett said, the best time to buy is when there's blood in the streets, even if it's your own.
Yes.
You get me? So right now, if you have cash, it's a
Buy.
good time to go and buy
Yes.
stocks because now they're much cheaper. They're on discount. They won't sell,
Yes.
literally. Yeah.
Okay. So in other words, it's not a very bad thing for now the people who are new people on the market. So it's a good time to buy
Yes.
as the markets go down.
Yes. The best time to buy is in a bear market because right now we're in what we call a bear market, when assets are pretty much being traded for as low as it can get. This is the best time to get in. You do not get in when
They're going up.
there's a hype and everyone is
Bullish.
saying,
Is it the bullish?
yes, because we have the bull market and the bear
The
market.
bear market, yes.
So when you heard about stocks, Tesla hitting all-time highs, just a few months ago, every other day, like Tesla stock was just going crazy. It went as far as I think $420, $600, right?
Yeah.
If you bought Tesla then, you're definitely in a loss.
Loss today.
Yeah, but if you buy now and just hold on to your stock, I can guarantee you that in a couple of months, because the market cycles keep changing. From a bear market, you go back to a bull market. From a bull market to a bear market. The next bull market, whoever buys now should be very pleased with their portfolio.
Yeah. Talking about investment, we would like to know how can people diversify their investments in as far as the geographical location is concerned. As you have said, companies here in Uganda, the market is not so active, and most people would maybe want to invest a little bit here and then elsewhere. Are there avenues we can use to actually tap into foreign markets?
Yeah, I've been actually quite impressed with some of the products on the Ugandan market. For example, I had Cheaper Cash. It allows you to buy stocks from the US.
Yes.
I heard about, is it Yellow Card?
Yeah, Yellow Card was a cryptocurrency.
Oh, it was a cryptocurrency, yeah.
Yeah.
But that's also a way of diversification because you don't want to own some stocks, you don't want to own some crypto, you don't want to own some real business,
Yeah.
you know?
Hands-on.
Yeah, hands-on business. Like you don't want to always be just invested in only the financial markets. If we're talking
Looking
about
at boards all the
diversification,
time.
yes, you want to structure your portfolio in a way that, in case of anything, if the financial markets are taking a hit, at least you're able to subsidize the damage or whatever from maybe your real actual cash flow business, a business that gives you cash flow, you know? And in terms of that, I would always say, even with the stock market, you need to look at industries. For example, during recessions, there are certain industries that continue to outperform the rest. Now, things like healthcare, because no matter how poor people are, if somebody gets sick, they're going to go and seek medication. They'll find that money. Food, people will have to eat.
Yeah.
Whether it's a good time or a bad time,
Yes.
they will have to eat. You know?
Yeah.
So things like that, healthcare, food, and even transport. Well, besides COVID and whatnot. But usually transport runs the economy. So if you need to invest in, for example, if we're looking at Ugandan stocks, you decide to invest in Cipla, that's healthcare.
Yes.
If you decide to, I don't know which company is listed for food.
Food. I'm not seeing any. I'm seeing banks. I'm seeing.
You see, now that's the thing. We do not have quite a range of items, you know, in terms of companies listed on the USE. But in Kenya, there's an interesting company called Twiga Foods. It was actually valued at $1 billion US. I'm not sure if they've listed yet, but that's definitely a company I would personally buy shares into, because for as long as you know that there's life, there will always be food on the move. And so you have to always structure your portfolio according to things like that, according to industries, whereby, you know, even in a recession, you're going to have performing. And in terms of like a boom, now that's why you start looking at the luxury stocks. You know, things like tourism, hospitality.
Yes.
That's when you want to buy
Hotels.
into hotels and all that stuff, because now people have the excess money to spend, travel, and whatnot. When there's money around, people will find ways to spend it. Yeah.
Now let's make it a little bit practical here. I'm a student at the university. I'm an adult working, starting out.
Yeah.
How much should I always invest in financial markets in terms of percentage? And then maybe also for the older people who are about to retire, 40, 50 years, how much should they invest? What percentages are you looking at? Small income I earn.
Well, Anthony, I will tell you one thing. When it comes to investing in the financial markets, the biggest thing is risk appetite, right? Because if, let's now, for example, take the example of the retired people, the old people. Such a person shouldn't look into investing in riskier assets. They would be better off investing in treasury bills, bonds, because those are relatively safe.
Yes.
And the returns are pretty much guaranteed. The return that you get so much at the end of maturity. You get what I'm saying? So it's predictable, you know exactly what you're working with. You don't want to be in a situation whereby you invest your money and then the economy takes a hit or the industry takes a hit and you find out that now you do not have enough to live off. And now you're old. It's not like you have the time to make that money again. Now, going back to the university student. As a university student, you're still young. You have your whole life ahead of you. So you should be more willing to take risks. You know, because like the saying goes, the higher the risk, the higher the returns.
Yes.
So in that instance, as a university student, you shouldn't be looking at investing in treasury bills or bonds.
Safe investments.
Yeah, you should. They shouldn't even be on the table. You should be looking at investing in stocks. Look at investing in crypto. Look at investing in such assets, but try to also balance them in a way that it's not fully detrimental to you in case of anything. You know, like for example, we're going to talk percentages here. If I were a university student, I would say that I would invest maybe 40% of my money into crypto. Right? I'd get like 40% of my money invested in crypto. Then I would get 30% and invest it in like stocks.
Yes.
And I'm talking about these high return stocks, things like technology and such industries.
Yeah.
We look at technology, that's your Tesla, that's your
Apple,
that's your, you get what I'm saying?
Amazon.
Yeah, exactly. And then I would get, so that's already 70%, right? Then I would use this 30% to actually try to find a business, a cash flowing business. Because remember, the financial markets require money.
Yeah.
And chances are
you have to feed
it.
Yes.
Exactly. So you need a cash flowing business that's going to enable you to actually keep investing in the markets. Every time there's a dip, you buy some more.
Yeah.
Every time there's a dip, you buy some more.
Yeah.
You don't want to get into a scenario whereby Bitcoin has fallen because you invested in stocks now, in crypto, and now you have to sell all of it because now you don't, you really need the money and whatnot. But if you have a cash flowing business, if it has fallen, you add some more, you keep building your position into like Bitcoin or Ethereum or whatnot, whatever you prefer to invest in, right? And that will help you in the long run, because 10 years from now, if I told you 10 years from now, 10 years from today, 10 years back, if I told you that, if you told anyone Bitcoin would be trading at 20,000, what people are claiming right now is, gloom.
Gloom.
If you told them 10 years back
Yes.
it would be trading at 20,000, trust me, they would be so happy.
Yeah.
So now imagine 10 years from now, because the way it works is a deflationary asset. The supply keeps reducing over years. Every 4 years there's
Because
increase.
it's fixed. It's about 21 billion US dollars.
21 million.
Million
Yes.
US dollars, and you cannot buy more than that.
That's it.
So meaning, as time goes by, it will reduce.
And you know the economic principle.
Yeah.
The scarcer
Supply.
something,
Yeah.
the price.
Higher the
it
price.
is. Exactly. So you'd want, as a university student, I would actually encourage them to get into crypto, and every time there is maybe a dip, whatnot, they keep adding to their portfolio. That will go a long way in helping them.
Talking about crypto, many of our viewers and even people in the public have criticized cryptocurrency, as many people have been fleeced of their monies in some scams, and people who come and close shop the next day after collecting money from people. And even the Bank of Uganda banned crypto transactions. Just earlier this year, they didn't officially come out, but they sent a circular saying that if you're participating in crypto, it's at your own risk, you know. And everyone is so negative. We even have comments every time we talk about crypto from people saying that, you guys, crypto is bad. People are just making losses. What is your idea about cryptocurrency?
Well, one thing I'll tell you for a fact is there's scammers everywhere.
Yes.
The scammers in crypto, the scammers in whatever industry you could think of.
Yeah.
I mean, we have people masquerading as doctors.
Yes.
We are like, there's scammers everywhere. But at the end of the day, what people do not understand is with crypto, you do not necessarily need to have another middleman to do for you all these
brokers.
You don't need that. And for as long as you do trust somebody else to be like your broker or your intermediary, then you're bound to lose your money. Because one thing with crypto is, if it's not your keys, it's not your coins. So that means you should take initiative to educate yourself about the crypto market, do your own research, find the projects that best work for you, because different people have different. Can I say what's the word I can use here? But different people have a strong affiliation to different cryptos for different reasons. There's some people who say, I'm a Bitcoin maxi. I only believe in Bitcoin. The rest, hell no. Then you'll find other people that say, no, I will only buy into Ethereum because I love how the project is moving, what it does, it supports NFTs. So different people have different reasons for investing in whatever crypto they choose to. At the end of the day, it's up to you. The onus is on you to identify a project or a crypto project that you're really interested in and find out how authentic it is. So for you to say it's bad just because somebody said, give me your money, I'll give. And another thing, by the way, that people ought to be suspicious of. In financial markets, we say returns can never be. That's how you know who's
not a must returns.
Yes, it's not a must. That's how you get who's a professional in the field and who is not. If somebody says, give me your money, every week I'm going to give you a percentage. Every week I'll be giving you 50% or 10% or 30%. They're not. Those people are going to run away with your money because no one can guarantee a return. All the people I've worked with, they come to me because of, let's say, my profile, and they say, so if I were to give you so much, how much would you give me every week? And I tell them, I can't guarantee you anything because I don't know how the market will move. What I can guarantee you is I'll perform in my best, at my best capabilities to minimize any risk of loss. But I cannot guarantee you that every month you're going to have so much. And everyone that usually does that, that's when you find cases of people running away with their money. Because they'll give them for the first 2 or 3 months, like maybe pyramid scheme, then you're encouraged to invest more, and next thing you know, they've closed shop.
Very interesting there. And of course, the other thing that most people are very inquisitive about is the kind of platforms that people can actually go on to get to learn more on financial markets and investments. How did you maneuver in the education bit? Because of course, even there are some platforms that probably don't give the right information. How does someone educate themselves about financial markets, the crypto, the stock markets, getting the right information?
Well, I would have said the internet, but you know the internet is filled with so much information, and you can never be so sure as to information. But for starters, I would encourage anyone, for example, if if you want to learn about stocks, the best way is to go on the exchanges themselves.
Yes.
They usually have resources and will give you an overview and whatnot about the stock market. So it will tell you how to invest in stocks, how to go about it, how to value stocks. And of course, other things would require you to have a deeper reading and understanding. For example, in as much as I went to school for these things, I had to do my own personal reading on the side. So what I did was I went and studied some of the greatest investors at the time, or even currently, because I read Warren Buffett's letters, shareholder letters, the Berkshire Hathaway. By reading them, you get to understand his thought process, how they value their things, how they do their work, and that allows you to get into, to peer inside the brain of one of the best investors there is. Then, of course, there's the book of The Intelligent Investor by his mentor. I don't know if you've come across it.
The book of The Intelligent? No,
yes,
not
it's
yet.
called The Intelligent Investor.
Mm.
How to value stocks and whatnot. It's by, I think, Benjamin Todd. Sorry, I'll just get the right thing right now. But
Yeah.
it's called The Intelligent Investor. It will show you how to value stocks, how they do it. And of course, when it comes to stocks, there's two ways about stocks. There's fundamental analysis and there's technical. The technical people are the ones that just look at the charts and follow price movements. You know, so you have a bunch of indicators to help you see when a stock is breaking through or it's going down. You look at the channels and stuff like that. So that's a whole other discipline as well. Then there's the fundamental analysis. So you, as an investor, you have to choose which one works best for you. Are you into fundamental valuation or are you into the technical aspect of it? So when you get around to that, then you'll be able to find a niche that works for you.
As we conclude, Mr. Musumba, that, like we've said, the companies here in Uganda, few listings, very little activity. What do you think government can do, or even companies should do, to see that we grow our stock market, at least to come to the level of Nairobi, honestly? Yes, we can say Nairobi is the oldest in East Africa, but they have really developed really fast, yeah? But they also still have a challenge, which many stocks in Africa face: foreign investors. Most of the people now, right now, the stock market in Kenya has been doing so bad because many foreign investors are selling off and going into other investments like treasury bonds and bills in their countries that are now more attractive with interest. What do you think we should do as the public, the government, and also companies to see that we grow our stock market and attract more people to invest?
That's actually a good deliberation. I, for one, would say the government should actually start putting incentives for domestic companies to actually list.
There should be some benefits to listing government.
Because I mean, you cannot force private companies to list on the stock exchange. What you can do is provide incentives, things like tax holidays.
Yes.
If you tell a certain company, let's say Mukwana, that for the next 20 years you won't be paying tax, if you list on the USE,
definitely they will list.
They will list. You get what I'm saying? So, and in doing so, we provide us ordinary Ugandans with a chance to take ownership of our economy.
Yes.
You know, because most of these countries, yes, we speak about foreign investors, but we do not have outflow regulations. I mean,
anyone can
you can come, invest your money, and you can take it all out.
The way you want.
And that's just what makes our economy kind of lag behind, you know. However, if we told those foreign investors that yes, come invest in our country, but do list on the stock exchange as well, you know, that will spur investment and growth in the country, because then you're going to have many people, many ordinary Ugandans owning a stake of the company.
Yes.
So instead of having a Chinese company come, extract minerals, whatnot, and then take back all the profits, you know, here we'll have some few Ugandan shareholders who will decide to use their profits to invest again into the country, as opposed to taking it, you know, abroad. So I feel like it's onto the government to make the capital markets really attractive to foreign and domestic investors, so that we can have a much more developed market going forward.
Yeah. Wow. Thank you very much, Mr. Musumba.
Thank you so much for having me, Anthony.
Yeah.
It was a pleasure.
Yes. We've had a very good conversation here on what the stock markets look like in Africa and in East Africa and in Uganda as well. I've been talking to Mr. Malik Musumba. He's a business person, an investor, and an investment strategist. So I don't know if you mind sharing your handles or something where people can find some content.
Yeah, sure. It's at Malik, MA, there's an underscore,
Yes.
LICK. Yeah.
Okay.
All right.
Thank you very much.
All right. Thank you, Anthony.
Yeah. Thank you very much for staying with us since the beginning of the show. Remember, you can always catch us every weekday, 10 to 1 p.m. And we will be here to give you wonderful weekend. Next is Mr. Makubuya with UG to Kole. See you around next week.